Okay, let's unpack this. We're talking about Beyond Meat, ticker BYND. And right now, this stock, it feels less like a company and more like a financial war zone. For years, it was this symbol of the future of food. Then 2025 happened, and it just became a symbol of disillusionment. The stock fell, what, over 78%? But what happened on January 2nd? The stock just it exploded. Sharp 7.49% rally, closing at 88 cents. And all of a sudden, across social media, the question wasn't about survival. It was, is the bottom finally in?
Exactly. And the analysis report we're dissecting today, it lays out this picture of just extreme speculation, high risk. So our mission for you is to really get the central conflict here. It's almost cinematic. You've got the company's undeniable, difficult fundamentals, the reality of their finances clashing with these explosive technical stats that are fueling, well, that is basically a meme stock setup.
It's not just a stock. It's a battle for survival in what the report calls a post-hype market. The tension is just incredible. To really get the gravity here, we have to start with the fundamentals. And they're catastrophically tough to look at.
We have to. It's the bear case, and it's the consensus view. The average analyst summary is firmly sell or underweight. And their reasoning isn't complicated. It's existential. The two big risks they cite are negative equity and, maybe more urgently, just this massive cash burn.
Let's pause on negative equity for a second. It sounds scary, and, well, it is.
It is. It means the company's liabilities, what they owe, now exceed their assets, what they own. Simply put, on paper, they are fundamentally insolvent. Think of their balance sheet as a kind of debt trap. It makes getting new financing incredibly difficult, and it just screams that a major restructuring, maybe even bankruptcy, is a real possibility.
And when you look at the recent numbers, you see exactly how they got here. Revenue is under serious pressure. It's down, what, 13 to 21% in their key segments. Q3 revenue came in at only about $70 million, which on its own is concerning, but then you see the costs.
That's the real killer.
Yeah.
The operational expenses are just staggering compared to the sales. The company reported a brutal operating income loss of negative $112.3 million in Q3, which led to a net income loss that was almost identical, negative $110.7 million. That kind of performance just bleeds cash. And if we look at the cash situation, I mean, the free cash flow, that's the cash left after you pay for everything to keep the business running. It's negative, estimated at about $105 million over the last 12 months. It's like a boat taking on water. They found a temporary patch, yes, but if that hole, the cash burn, is bigger than the pump, you know what happens?
And the weight on that sinking ship is the debt. Their total enterprise value is around $1.5 billion, but a huge chunk of that, $1.1 billion, is debt. That number, $1.1 billion, that's the fundamental killer. Just servicing that debt while losing all this money, it gives them zero room for error.
And the survival risk isn't some abstract idea. It's measurable right now. The stock is fighting, and I mean fiercely, to stay above the $1 mark.
To avoid the NASD QD listing warning.
Exactly. That is a sword of Damocles hanging right over them. If they fail, it drastically restricts who can even own the stock. It signals a catastrophic loss of confidence, and you often see this death spiral in liquidity.
It's a really terrible picture. But to be fair, they have secured a temporary lifeline.
They have. They made some operational cuts and, crucially, got a $100 million financing deal from an Ahimsa Foundation affiliate. It bought them time. The analysis actually shows their current ratio is a healthy 4.54.
So they have cash on hand for immediate bills.
Right now, yes, the money is there. But that $100 million just slows the inevitable if the core business doesn't turn around. And that's why the fundamental risk of bankruptcy, that's the anchor of the bear argument.
Okay, so the fundamentals are a catastrophe, basically held together with a short-term cash injection. But disasters like this, they often create their own energy. When bankruptcy risk is this high, it becomes the perfect playground for short sellers, which, ironically, is what creates the whole technical opportunity. We have to flip the script.
And this brings us to the heart of the speculative bull case. The story stops being about whether you like their plant-based burgers, and it becomes all about market mechanics. Specifically, the technical setup that fueled that huge rally on January 2nd.
And the data here is it's explosive.
It really is. The biggest factor, by far, is the short interest. The short interest as a percentage of the float is at a massive 28%.
Okay, for anyone not familiar, what does that actually mean? 28%.
It means that for every 100 shares out there available to trade, 28 of them have been borrowed and sold by people betting the price will go down. And that number is so critical because it represents guaranteed future buyers. If the price moves up, they have to buy the stock back to close their position.
So when short interest is that high, at 28%, what's the mechanism that flips the leverage from the shorts back to the bulls?
It's pure price action. The price starts to rise, and it forces those short sellers to cover their bets. They have to buy back the stock, often at a higher price than they sold it for.
Creating more buying pressure.
Exactly. A feedback loop. And the bulls will point out that despite all the losses, the valuation relative to sales is just absurdly cheap. The price-to-sales ratio, the PS, is 0.23 right now.
A PS of 0.23. In practical terms, what does that suggest for the listener?
It suggests the market is valuing the entire company at just 23 cents for every dollar of sales they make in a year. For any company in the food sector, even one that's struggling, that is extremely low. The bull argument is simple. If they can just stabilize revenue, the stock is ridiculously undervalued on that metric alone.
And the analysis report, it adds to that optimism. It mentions a narrative fair value of $1.61, which would suggest the stock is, 45% undervalued right now?
Relative to those long-term projections, yes.
But let me challenge that for a second. That $1.61 value, it depends entirely on them getting to EBITDA positive status, meaning they actually start making cash from operations. Given the losses you just detailed, over $100 million in one quarter, isn't a $1.61 target just pure hopium dressed up in a financial model? How realistic is that?
It requires a huge leap of faith. It's an evaluation based on if they pull off a perfect turnaround, not where they are today. But, hope is exactly what fuels this kind of trade. And the technical defense on the chart is loud right now. The stock's at 88 cents, just off that 52-week low of 50 cents.
And that volume number from January 2nd, 43 million shares traded. That's a huge tell. It suggests that the 80-cent level is being very aggressively defended by bulls who are trying to force those shorts out.
And there's history here. We have a precedent for why traders are lining up for this exact setup. We saw a massive short squeeze back in October of 2025. This very stock, with a similar level of short interest, went from 50 cents all the way to $7.69 in a matter of days.
A 1,000% run.
A 1,000% run, fueled entirely by short sellers panicking and being forced to close their positions.
That 1,000% run sounds incredible, but it also implies a lot of people bought in at $5 or $6 and are now sitting on huge losses. So isn't playing this squeeze just a massive gamble that listeners should approach with, extreme caution?
Absolutely. When you bet on a squeeze, you're betting on volatility, not value. You're gambling that history will repeat itself. You're betting that the panic buying from shorts will happen before the fundamental bankruptcy risk becomes reality.
So we've laid it all out. The extreme bear case billion-dollar debt, delisting risk, cash burned, and the extreme bull case 28% short interest, and the ghost of that last squeeze. So now we have to synthesize these two opposing forces.
The chart interpretation is everything right now. Is this recent bounce a classic dead cat bounce?
A temporary recovery before it collapses again.
Right, a small blip before the fundamentals pull it back down. Or is this 80-cent area a genuine double bottom formation?
Signaling that the low point is in and the momentum is shifting higher.
And this is why the analysis gave us a very clear critical threshold. The whole verdict hedges on one price point. If BYND can break, and more importantly hold, above $1.10, that 28% short interest could absolutely trigger a significant event.
And they call that event a gamma squeeze.
Okay.
We need to clarify what that means because it's a term people throw around a lot.
A gamma squeeze is like a short squeeze on steroids powered by the options market. As the stock price rises toward key levels, the market makers who sold call options are forced to buy shares of the actual stock to hedge their risk. This forced buying creates a chain reaction. It compounds the short covering and just rapidly, violently accelerates the price upward. That $1.10 level in this analysis is seen as the ignition switch for that whole chain reaction.
You can just see the uncertainty in the price targets from the report. The average is $2.57, but the low is 81 cents, basically where we are now, and the high is an incredible $6.90. That spread is enormous. It just underscores that this is a high-stakes gamble with no real consensus.
And if you look at the bigger picture, the market first valued Beyond Meat like a high-margin tech company. But that fantasy dissolved when the big food producers came in and turned plant-based meat into a low-margin commodity war. That $1.1 billion in debt is essentially the bill for a failed market domination strategy.
So what does this all mean for you, the listener? What's the takeaway? This is a quintessential example of financial speculation. You have this massive fundamental risk clashing directly with intense technical pressure. The stability the company has right now is purely tactical. They bought time with that $100 million lifeline.
Exactly. But time runs out. The next major fundamental update is the Q4 earnings report. That's expected in late February 2026. That report will either justify the bull defense or, solidify the bear thesis. It's a huge catalyst.
So the core tension heading into February is this. Is the bottom truly in, defended by short covering momentum? Or will the weight of negative equity, that billion-dollar debt, and the cash burn finally cause a total collapse?
Which brings us to a final provocative thought for you to consider based on everything we've discussed. Given that the primary bear argument is fundamental bankruptcy risk, yet a technical threshold of just a $1.10 could trigger massive short-term gains, we have to ask, in a highly speculative binary environment like this one, which factor holds more immediate power over the stock's trajectory? Is it the technical trading volume, or is it the underlying financial health of the company?